you so much for joining us. So I will be moderating today. I'm a full-time employee at Apple. I do technical program management, and I'm also a passive investor with Touzi Capital. Have had great experiences, and I'm working with the fabulous Mia Reeves as well with accounting. So just quickly introducing Eng. He's the CEO of Touzi Capital and former Apple employee. And Mia is the wonderful real estate accountant, and they'll go ahead and give some deeper introductions in a second here. On housekeeping, I will be doing some Q&A as we go. So if you have questions, please just drop them in the chat, and I'll be pitching them up to Eng and Mia so we can have a little bit more of a discussion as we go.
Sounds good. And I will be driving the presentation, but I want to make sure you guys can ask questions as we go. We'll have quite a number of slides and a lot of examples we want to highlight. But we will be going over time. We'll have some time afterwards to do Q&A as well. But of course, we'll want to make it as interactive as possible. So feel free to ask questions in chat. If Brett thinks that it's a good interjector, we can definitely try to answer it. And of course, we have Mia here to help answer all your CPA questions. And we have a special benefit announcement at the end of the presentation as well. So let's begin. Today we're talking about real estate and taxes. And before we do that, I want to introduce myself. So I have a pretty varied background. I went to Wharton, degree in economics, was an ex-investment banker, did Peace Corps, where I met my wife, did a lot of jobs in analytics, and then joined Apple, where I worked in business management for iPhone, product management for Apple Music, and most recently, leading data science in Siri. And I am the CEO and founder of Touzi Capital, which is a syndication and real estate investment company. And I run a fund currently with nearly $100 million of assets under management. I have been an investor since 2009, and I'm not a tax professional. So I will be presenting quite a bit, which is confusing because you have a tax professional right here. But hopefully I can make it a little bit more relatable, and Mia will check my facts, and this can be as fun and interactive as possible. And so Mia, why don't you introduce yourself?
Yeah, so as Brett and Eng introduced me, I'm a CPA and real estate investor. So I've been investing with my husband for 8 years. And I've been running my own accounting business for 3 years. And we've grown from just having a few clients to a team of 4 professionals and over 150 clients as our client base. And we work primarily with real estate investors and realtors, brokers. So most of my clients have some involvement with the real estate industry. And the reason why I just love real estate so much is my husband's one of the investors. I've been helping him with his books. I've been doing a lot of his accounting, and I just realized, well, I want to do something for all the investors out there, not just my husband. I graduated from TCU. I originally am from Vietnam, so I came here when I was 18 on a full tuition scholarship. But I've always loved real estate, and I always loved just being an entrepreneur. And so my mom gave me the Rich Dad Poor Dad book when I was 12, and I fell in love. And since then, it's still my favorite book. And so through this webinar, hopefully I can teach you guys a little bit more about, the upcoming Biden tax plan and how it potentially affects you guys. Now, I have to say that when you go through this presentation, everything I'm talking about is not a certainty. It's just our interpretation of Biden tax proposals. So don't rely on this as tax guidance. Please consult with your CPA or attorney before applying any of these strategies or making any changes to your financial situation. So we do provide a one-on-one consultation for free. If you have any questions on your own situations and you want to talk about anything specific that you don't want to talk to the whole audience about it, so we can do that separately. So that's my information. If you want to go to the next slide, Brett.
Yeah, and thanks Mia for that disclaimer. I probably should have said that as well, but I'm not CPA, so that's what we bring to the table here. So I think Mia will be going through the Biden tax plan. So by the way, one thing I want to highlight here that we're going through just specific parts of it, but Mia will obviously knows all of it. We wanted to talk directly to this audience, which is made of a varying group of real estate investors, Apple employees, and of course, Mia's clients potentially.
Yeah, I speak really fast, so I'm going to try to slow down. And then, of course, we have this whole webinar recorded. And so if you guys want me to kind of answer any questions, we'll leave some time for Q&A at the end of this session. So thanks, Eng, for backing me up. Anyway, so this is the tax. There's just a lot of different changes that Biden has proposed. So in regard to Joe Biden's tax plan, there are many recommendations, but as you can see, there's a list here, and I'm going to go through some highlights that I think would affect you if his bill go through. Now, I think if anything happens, in my projection, and you can tell us about what you think. I think if there's any changes, there might be another stimulus package. Some changes happening in Q1 of 2021, and then if there's any changes, the change is going to be probably in the summertime or toward the end of 2021, if any, but I'm hesitant to say that you can rely on any of these because we have to wait until January 5th to see what comes out, see who wins the Senate. So you can go to the next slide, please. Okay, so as you can see in here, this is a tax table that we just took from the IRS website and added a few, some information. So the Biden tax plan would increase the current highest individual income tax rate to 39.6% from the 37%, as you can see in here. The current marginal income tax rates are 10%, 12%, 22%, 24%, 32, 35, 37, with the threshold for each of these rates varying by filing status. No further details have been provided relating to this calculation, and therefore we make assumptions that the top tax rate of 39.6% will start at $400,000 in accordance with the Biden theme of Joe Biden will not raise taxes on anyone making less than $400,000, period, but he will ask wealthy Americans and big corporations to pay their fair share. For single, married, filing jointly, head of household, and qualifying widowers, we're making the assumption that the upper tax bracket starts at $400,000 threshold, rather than simply replacing the 37% bracket with the 39.6% bracket. And so, as you can see in here, only the people making more than $400,000 in taxable income will be affected. You want to go to the next slide, please?
Mia, just quick question on that. Is the $400,000 per household or per individual?
If you can go to the last slide. So it's for household and individual. So whoever make more than $400,000 could be heads of household, widowers, individual or married filing joint.
Thanks.
Yeah, you're welcome. And then next one is the elimination of Social Security tax cap. And so currently both employers and employees pay old age, survivors, and disability insurance, meaning Social Security tax of 6.2%, each on wages up to $137,700. After that, no additional Social Security tax is paid by either the employer or the employee. Now, the Biden plan will start taxing Social Security again for wages over $400,000. So this will leave a donut hole between $137,700 and the $400,000 that will not be taxed. So, this new tax threshold has no upper limit. So all wages above $400,000 will be taxed at 6.2% for the employer and 6.2% for the employee. And the portion of the wages below $137,700 will continue to be taxed as they are currently. So again, this only affects the people in the high income tax brackets, and the people that make less than that will not have to worry about it. Yeah. So, and then Biden also proposed the itemized deduction changes. Now, there are several proposals that can change the itemized deduction. First, it would eliminate the current $10,000 state and local tax limitation implemented by the Tax and Jobs Act. So for those of you who live in California who is not very happy because you can't deduct the state taxes, over $10,000, right? Or the property tax is over $10,000, this is something that's actually going to be good for you because you can deduct more than just $10,000 in your itemized deduction. I have a client that lives in California and he has a house that it was like, I think over $2 million. You can imagine he paid a lot in property taxes, right? And because of the tax cuts and job tax, he can only deduct $10,000. So it's pretty sad. And then second, it would cap the benefit of itemized deduction to 28% of adjusted gross income for taxpayer earning more than $400,000. And third, it would reintroduce the PEAS limitation for taxpayers earning over $400,000. And the PEAS limitation will gradually reduce the value of itemized deductions based on income. So next.
Yeah, that soft limitation really hurt us, for us fellow California taxpayers.
Yeah.
Especially with the house prices well over $1 million on average.
Right.
Those in Texas, I don't know
so
why
you
not
do
move.
tax planning.
Yeah, exactly.
And then here I'm going to talk about a few tax credits that will affect you. Earned income credits will be expanded to childless workers over age of 65. And then child and independent care credits, the limit of that will be increased from $3,000 to $8,000 up to $16,000 for multiple dependents. Meaning, you have a child, right? And then so currently you can eligible for $2,000 of child tax credit, meaning $2,000 cash, not deduction. Now with this new law, you're eligible for $3,000. So you have two children, so you can get $6,000 of credit instead of $4,000.
It's still not RI positive, guys.
Yeah.
It's not nothing you can make money from.
Well, I tend to be pretty positive, but I don't know if you guys know, there's like a survey or a study saying that if your kid would cost you $250,000 at least, like from the age of 1 to 18. So this is really nothing compared to how much you pay, but it's something. And then child tax credit, first-time home buyers credits. So reestablished the first-time home buyers credit to an advanceable refundable credit of up to $15,000. So this is going to be good for some of you guys who want to buy your first home. And then the renter credit, it's going to create a new, they're going to create a new refundable credits for low-income renters that would cap rent and utilities at 30% of monthly income. And then also Made in America credits create a 10% advanceable tax credit for revitalizing existing closed facilities, retooling certain facilities, and reshoring jobs to U.S. facilities or expanding current U.S. facilities. So this could be something that's good for you guys. Do I have any more slides? I think that's it. Okay, so that's it from my part, and I'll turn to Eng to talk more about his perspective on Biden tax plan and some of the tax strategy that he used as a real estate investor.
Yeah, and I like to create these slides without really showing Mia, and so some of these will come as a surprise because I want her to check me on some of these things as a real estate professional, as a real estate, obviously it's real estate CPA. But we talked about the Joe Biden tax plan and what it potentially could have an impact on. Obviously, we don't think it will happen relatively soon. I don't think it'll happen at all. There are 4 main reasons why, and I have good connections in Capitol Hill as well as lobbyists, and I follow politics quite deeply. First, of course, is the Georgia runoff. That is definitely not a sure thing that the Democrats will win both seats. They typically do very poorly in off-cycle, and when you don't have someone to vote against, you might lose a significant portion of your base of voters. That will, even if they did win both, they would have a slim edge in the Senate. Now you gotta remember, the Obamacare passed with a supermajority vote of 60 senators to 60 Democratic senators. And they could barely hold on and they couldn't pass anything else for the 8 years. Obama was not productive. Of course, obviously had opposition party that hampered him. But imagine the opposition party that had 50 senators. You just need a Joe Manchin or another senator in the red state, Democrat senator, to buck the trend and go over to the Republican side. So those are the two reasons why I firmly believe that Biden won't pass any tax laws. In addition, no major tax laws or major laws get reverted this quickly. It usually takes at least a decade for something that passed in 2017 to get reverted. While Biden talked about taxing the wealthy and taxing the rich, it is not a priority. Democrats have a long list of priorities that they rather tackle. Stimulus being paramount to that, the pandemic, as well as other justice and social changes that are more, they rather use their social capital or their political capital on, if they have any. Now, this isn't to say this won't happen. This is to say that it needs congressional approval and tax laws to make these happen. Most of what happens now in the government is executive orders, and executive orders cannot change tax laws. And I'm not alone in feeling this. Most CEOs, CFOs feel confident that Biden won't be able to raise the corporate tax rate to 28%. Essentially, they feel confident that nothing will change, and that has been shown in the market rally that you've seen, and the confidence in 2021 for corporations as well as those connected. So whether you like that or not, I believe that's going to be the case. So I want to then transition to talking about how to pay less taxes, which is, I think, where everybody can try to take advantage of and really should be trying to do. And really, I like to talk about it as how to keep more of your earnings. Because ultimately, you earn this. You really should pay less taxes legally as much as possible. Because I think you're a better advocate for your own capital. And when it's about taxes, it's about the facts. So you have to rearrange the facts. And I presented this before. And one of the rearrangements is a deferral. So that's what I want to talk about for the rest of these slides. And the three types of deferrals that I really want to highlight is depreciation, one of my favorite topics, one of my favorite things in the world, a 1031 exchange, and opportunity zones. All three types of deferrals. With depreciation, I'll go into some case studies for all three of them, as well as talk about bonus depreciation and cost segregation study, which, by the way, Mia can definitely help with all these three.
Eng, just a quick question. Can you elaborate a bit more on how the capital gains tax increase and how that will affect real estate investors?
It will affect capital gains on the top end. That will, I honestly don't think it will happen, but if taxes go up, you pay more, I guess.
I can help a little bit if you want. The capital gain tax rate is currently at 0%, 20%, and 0, 15, and 20%. If things are going to change, which we don't know, I'm going to stay a little neutral here because I tend to be a little conservative. But hey, if the corporate tax rate is going to jump, it's not going to jump from 21 to 28%. That is great news for myself and a lot of clients, right? But anyways, the capital gain tax rate is going to only affect the people in the highest income tax bracket. So it's going to jump from 20% to 39.6%. So the people in the middle income tax bracket, or a lot of you guys are W2, you're not in that highest tax bracket, you should be fine. I don't know if I answered your question.
Yeah. And we have another question on why Biden can't change tax laws to executive orders. So executive orders can only change very minor parts where agencies have control. Agency, including the IRS, he can dictate some policy, but he cannot dictate how the government collects taxes. That is a purely congressional responsibility. Obviously, the Congress has advocated a lot of the responsibility, but it's still their responsibility to change the tax law. And I would try to speak slower as well. I know me and Mia both speak fast.
And then there's just one more question for Mia. If Biden eliminates the 10K limit on state taxes, does he also have AMT limits to be lowered as earlier?
Yes, there is. And I have a kind of like a note on that to be honest, it's a lot of information. So if I don't look at my notes, I would forget things. But yes, the answer is yes.
So going back to deferrals, I think I'm going to talk about deferrals and in the concept of opportunity cost, because I think when you do deferrals like a 401k, you have the opportunity cost of not paying the taxes now, and you pay the taxes later. But in real estate, it's even better because you're not paying the tax rate on the net profits in the future. You're paying the taxes in an absolute sense in the future. When you have a deferral and you are able to invest that deferred taxes, say at 12% cash flow, which is pretty standard for some of Touzi Capital's deals for 10 years, you can gain a lot of profits. So that's really the opportunity cost of not paying taxes now and having to pay taxes in the future. You really want to consider opportunity costs when you think about deferrals and depreciation. So when you look at depreciation, on the same example, if you invest $100,000 and you were able to essentially not pay taxes on that $100,000 at a top end marginal rate of currently 37%, you save $37,000. That gets recaptured and depreciation recapture gets classified then as long-term capital gains, but as capped at 25%. Mia, correct me if I'm wrong. This is so not only is depreciation shifting things to the future and allowing to invest the full capital that you've earned or you've made, but you're also changing the tax rate from ordinary passive income into long-term depreciation recapture rate of 25%, capped at 25%. So that in itself, so I want to highlight that strategy, that deferral in itself is one of the most amazing things, especially if you are able to invest and compound that. Another thing that we often forget about is inflation. You owing the same amount of taxes, even if I didn't convert the 37 to 25 in the future, if I said you owe 37 now, and now you owe 37 in the future, owing 37 in the future is amazing because you haven't paid interest on it. There's no interest accruing on it, and the value of the dollar erodes in the future. So if you save $37,000 now, in the future, that would be an equivalent of saving $45,000 in the future. So you would actually net $20,000 in this example by both having that conversion of your tax rate for depreciation into something that is more favorable, and also inflation. This is why I also love long-term debt, because debt is a hedge against inflation. We all know that the dollar is depreciating, that our dollar will be worth less in the future, especially with quantitative easing and the Fed injecting trillions of dollars into the capital markets. There's no way for inflation dollar value to go up. It will go down, and real assets will go up in prices.
And on a note on inflation, you're pretty conservative here when you put 2% as inflation. And so with the government pumping money into stimulus bills and things like that, inflation, I would say probably more than 2%.
Yes, exactly. And I was being conservative here. If it's 3%, it's going to compound even more. So really the concepts here are net present value, opportunity cost, and inflation and the factors. So deferring things to the future is almost a great thing, especially if it's an absolute level, right? It's not like a 401k where you defer paying taxes now and then you pay taxes in the future, which by the way, those taxes in the future could go up. But if you were able to compound it and the taxes in the future goes up, tax rate in the future goes up, but it's really not on, it's not on the same dollar, it's on the same dollar value. It's not on a compounded growth rate. That's going to be, that's why it's very different than a 401k.
And even with the 401k, you can even use your 401k to invest in real estate too.
Yeah, you can do it solo 401k, which would probably be the preferred method to do it, or a self-directed IRA. Of course, you want to be considerate of UBIT taxes. And if you want to know what that is, Mia can tell you. Depreciation is one of the really cool things, and every time I explain it to somebody who isn't familiar with it, it kind of blows their mind. If you think about it, if you buy a income producing property, you can depreciate the carpet. And then if you sell it, that person can depreciate the carpet at a higher value. That carpet is having a lifespan that just keeps going up and depreciating, going up and depreciating. And you can depreciate as many times as you want, as long as you sell to another party. So I want to highlight depreciation as an example. And there's a lot of numbers here, and I'll try to walk you guys through what I'm referring to here. So imagine investing $100,000 in a real estate investment deal, like it's Touzi Capital, or just buying something in a single family house. Imagine now getting 12% cash flow every year, which is very typical in some cases. And you've made $12,000 a year, but in this scenario, you also are getting $12,000 of straight line depreciation. Residential is 27 and a half years, and commercial is 39 and a half years. So in this case, you're gaining a net value every year of zero from that reporting your taxes, but in your pocket, you're getting $12,000, which you can hopefully reinvest, compound, and grow. So this is a real world example, because in my scenario, I have made significant cash flow throughout my real estate investment experience, and I probably have paid close to 4 to 5% on the total cash flow that I've made. And I'm making multiple six figures now on my cash flow, and I don't expect to pay too many taxes on that because of the benefit of depreciation. And remember, depreciation is just a deferral to the future. But you're deferring the cash flow now, and you're deferring it and converting it to depreciation recapture rate. So in this scenario, you took $60,000 of straight line depreciation, and if you held it for another 5 years, you get another $60,000. If you held it for another year, you get $12,000 every year. You are able to then pay that $60,000 at a depreciation recapture rate of 25%. So you pay $15,000 at the end. So that's a really cool thing, that where you didn't have to pay taxes on the $60,000 during the whole 5-year lifetime, and you have to pay only $15,000 in the future. So both a deferral and a redefinition of your taxes.
Eng, I promise this wasn't a plant, but a question is, where can you typically get 12% cash flow?
Yes, at Touzi Capital, almost all of our deals are 12% at the very least. For those who are investors, you guys know what's up. Feel free to reach out to us afterwards if you guys want to learn about those investments. There are several levers of depreciation, and I want to highlight those levers because it's going to matter how you buy. In the example that I was referring to, where you got $12,000 of losses on $100,000 capital invested, I assume a 75% leverage. So I bought something for $400,000. I assume a 20% land value. So the depreciable asset was only, what's 20%? 320,000 depreciable asset. Take 320,000 divided by 27 and a half. That gets you 12,000, or roughly, maybe a little less. The levers that change that 12,000. Remember, you want that 12,000. You want that to be at least what cash flow is, so you can just wash out and pay net zero in taxes. If you get lower leverage, and some people here might say lower leverage is good, it's safer. Yes, that's true. So I'm not saying higher leverage is better. It is better for depreciation. If you get lower leverage, in this case, 65%, you have to put more capital in, and the bank or the lenders do not share in depreciation. So you, as the capital or the equity investor, gets the full share of depreciation. And so in this scenario, by lowering your leverage by 10 points, you also lower your depreciation benefit, yearly depreciation benefit, from 12,000 to 8,000. Another lever of depreciation is land value. For those living in California or in the Bay Area, land value is not 20%. It's definitely more, could be more than 40% of your purchase price. And when you have higher land value, that means you can depreciate less of the asset. And so in this scenario, you're depreciating only 60% of the purchase price. And of course, you have to leverage compound it into it. So then those two factors have your makes your depreciation benefit go in half. So when I invest for cash flow, and I love investing in Kansas City. That's some of my investments that I've made in the past and are currently making. Why I like cash flow investing is because I can get higher leverage. The banks will not typically give you higher leverage for low cash flow properties. If you're investing for appreciation, they will want to make sure that you have the income to pay for the debt. The income for commercial properties come from the commercial property. So they want to make sure that you get as low as leverage to where they feel comfortable that you have the cash flow. So that's why I buy for high cash flow assets, and Kansas City has that availability. So there's a lot of other places. So when you buy for cash flow, you can get higher leverage. Another reason why I love Kansas City is because I can claim that the land value is not that high. And this is a real world example of something I done last year where I claim a 5% land value, which allows my total purchase price to be 95% depreciable. With 20% equity in, I have a huge margin for depreciation value to get benefit. That's a couple of factors that you should consider when you invest in yourself or any deal. So just to recap, if you were getting 25% leverage and 100% land value, you get a yearly benefit of $12,000, and on a 12% annual gain, you're actually be paying zero in taxes. If you have lower leverage or higher land value, you'll be paying a little bit more taxes. You still save a little bit. If you do what I do, you might be paying nothing in taxes, and also be able to use the extra $5,000 to wash out any other passive income that you might have, or if you're a real estate professional, wash out any active income you might have.
And Eng, I've got a question for each of you. So this first one for you, Eng, what does this apply to investors of limited partnerships or versus hard assets?
Yeah, so if you are investing in a REIT, you do not get the depreciation benefit. But if you're investing in a private equity limited partner deal, like what we do at Touzi Capital, you get a K1 at the end of the year, or really in March, that will highlight your partial ownership of the property, and you'll get a P&L statement essentially highlighting the gains that you made and the losses, which includes depreciation. So we pass through those losses to the LP investors. That's one of the reasons why I really like investing like that, and one of the reasons why our investors enjoy investing like that as well.
Great.
Yeah,
and then,
go ahead.
Oh, it's okay, Mia, if you wanted to add to that. I have another question for you though.
Oh, okay. Well, I was just saying that if you're a limited partner, you get the depreciation, but if you are not a real estate professional, then it would just be a passive loss for you until you have passive income to offset it. If you're a real estate professional, then you can use that loss to offset against your active income.
Yes, that's very true. And so don't be too optimistic on what you can do with those losses. Just be optimistic that your losses can wash out your passive income. And hopefully you're investing for cash flow. Hopefully you're investing at 12% or more. And that 12%, if it's non-taxable essentially, or not tax deferred, that's an equivalent of something like a 17% yield in a taxable type of income.
Great. And then still a couple more questions here. This one's for Mia. Why should we do tax planning now instead of during tax time?
Yeah, great question. The reason why we should do tax planning now is I think we live in a very uncertain economy, in very uncertain time. And so I think this is the year end. So a lot of people contact me, in the middle of the year, at year end, at tax time. But if you contact me at tax time, it's probably too late for some of the tax saving strategies. So I would say, as a proactive CPA, contact me as soon as you can, so we can look into your situation and see if there's anything we can do to save more in taxes. Being proactive is better than waiting until the last minute or not filing your taxes, and then wait for like 3 years and contacting a CPA, right? And so I always say, contact a CPA, if not me, then someone else to help you plan ahead.
Mhm.
Perfect. And how many years can passive losses be carried forward?
I think it's 20 years. Or indefinitely, you guys can correct me with that. He's probably, I would have to look actually, but I do think it's like, I think it's 20 years.
Yeah, I think it's 20 years or indefinitely, depending on the type of losses. I know depreciation can be carried forward indefinitely as part of the 2017 Jobs Act. I believe maybe other losses, passive losses, which includes any capital expenditures that you might have, or losses based on not making enough rent and having more expenses.
Great. Still a couple, several more questions coming in here. Mia, another one for you following up on the strategy planning. What's the difference of tax planning versus preparation?
Yeah, the planning is you would talk to a CPA or your financial advisor, hopefully before you make any significant investment or any significant changes to your financial situation. So we can tell you, hey, maybe you should look into investing in this opportunity zone, or maybe you should look at cost segregation. And tax preparation is you just do things after the fact. So I have a few clients that talk to me that they sell their primary house, but then they just live in the house for like a year. And so if that's the case, then they have to pay capital gain tax on the sale of the house, versus if they contact me before they make that sale, then they can potentially, not have to pay taxes on that. So just an example of the tax planning versus,
That's a great point. I think tax planning is 24/7, 365 days a year. You should really talk to someone like Mia well in advance to really plan out your strategy. I sold my house this year. I sold it at a loss. Most houses that I buy, that I live in personally, are I lose money on because I don't the opportunity cost. But in this case, I bought it at a loss because, and if I had rented it out for 12 months, I could have taken those capital gains losses and washed out some. But if I didn't, if I lived there, which I did, I am not able to take those losses. So really, it's a lot about those type of questions that you're planning a year out or 6 months out. You should talk to a CPA.
Great. A couple other questions on depreciation loss. This first one is, how will depreciation recapture impact future potential gains?
So depreciation recapture is, and Mia, correct me wrong, is separate from future capital gains. It's additive to when you sell. Of course, if you don't do a 1031 exchange, which I'm about to go into. So it doesn't necessarily affect the future capital gains that you made or losses, or hopefully gains that you made.
And I believe that even if you don't take a depreciation, you still have to recapture it when you sell. So it's like a loss for you anyways, if you don't take advantage of it.
Yeah, so you definitely should take advantage of depreciation because the government will assume that you did. And if you didn't, then you're essentially paying depreciation recapture on the straight line and you didn't take any advantages of it. So if you have any income producing property and you're not depreciating it, you should change your CPA or get a CPA.
I guess you can, if worst come to worst, we can amend your tax returns back 3 years and take advantage of that. But it's just a hassle to have to go through the whole process, and your CPA probably charge you more, and you might be more susceptible to an audit if you do it that way.
Mm-hmm.
And Eng, I know for this other question, I know you have a slide later on about real estate professionals. You may want to hold it, but the question is about depreciation losses wiping out passive versus active income.
Yeah, it's going to wipe out only passive income for anyone who's not a real estate professional. And so remember, there's 3 silos of type of income: active income, portfolio income, and passive income. The portfolio income being stocks and dividends and trading, and then or active income, which includes some of the short-term benefits of selling and buying stocks, as well as selling and buying real estate if you hold it for less than a year, where you flip houses. That's an active income. And of course, your day job. So I want to plow through ahead a little bit, and then we can, at the end of this section, we'll open the questions. So one thing that as part of the 2017 Jobs Act allowed us to do is to take bonus depreciation on real estate. And how you do this is you do a cost segregation study. And by the way, Mia, I think, has a software that can help with that. But essentially, you are able to do a depreciation on an accelerated level on 5, 7, 15-year categories. And I'll highlight what those are. And the really cool thing is, if you can apply it for buildings that you bought in the past. So you could actually go and do a cost seg study on something that you bought already. So you don't necessarily have to do it on stuff that you buy in the future. So if you bought something in the past, if it's worth a certain value, consider doing a cost seg study, being able to take that advantage. Would you recommend that, Mia? You seem muted.
Yeah, I mean, that would be depending on the purchase price of the property.
Yeah, depending on the
say,
purchase price.
I would say cost segregation can always help you reduce your taxes. I have a client that they purchased a property that is around $800,000 purchase price, and then they get a $57,000 tax savings from doing cost segregation. They have active income, so always a good strategy.
I want to highlight some copy paste PDF that I received from a cost seg study that I did recently. So one thing that you see here, and it's a lot of information. So I just want to highlight the fact that you can take a lot of your benefit for example, in this case, I'm buying a big property for like $7 million, or I think it was 5 from 5 in this case. And I'm in the first 5 years, I would have been able to take on a $549,000 worth of depreciation. But with the accelerated bonus depreciation on the 5, 7, and 15-year property values, I can take a lot of that in the first year and accelerate basically all of it in the first year. And for the rest of it, take it straight line. And I've tripled my 5-year depreciation benefit. That allows me, based on all the stuff that we talked about, net present value, opportunity costs, deferrals, to take a big advantage early on. Of course, there's a cost associated to each of these cost segregation studies. So as Mia said, a certain purchase price, it would probably be a thing that you should consider, because there's definitely a cost. In this case, there was a 143 to 1 benefit on the cost of the cost seg study. And of course, if you can get a cheaper cost seg study, maybe that goes a little bit higher. Here's another eye chart, but one thing that you want to see is there's 2 columns: depreciation without cost seg benefit. And this is something I bought in mid of 2020. Depreciation with cost seg study. So you see that every year after 2020, you get a little bit less because you've accelerated, right? The same amount of depreciation. It's just that you're taking it earlier. You're deferring more of your taxes earlier. If you can use that, you can defer more of it earlier. You've accumulated that depreciation benefit, and so your net present value cash is really high early on. This is why you see a lot of real estate investors also buy and sell fairly quickly. They might not want to wait the full 27, 39 years to have depreciation go to 0. And when they do, they want to potentially sell and buy something else so that they can get a new depreciation benefit. So I want to highlight this in a real world example as well. Remember that example that I'm referring to, the investing $100,000, get 12%. In this case, you initially you save $22,000 of taxes. In this case, you get 60% bonus depreciation because you get all that early upfront. Instead of getting 12,000 every other year, you get 9.6 because you've taken a lot of that upfront. So in this case, you owe more taxes, but if you're able to shelter this for other things, other passive income, you would have saved more as well. And if you're a real estate professional, you can use that for your active income, which is if you're, say, a software engineer at Apple and married to somebody who has free time to be a real estate professional, that could qualify. Talk to a CPA about how to qualify, of course. And of course, if you don't use that depreciation benefit, it carries forward indefinitely, and you can use it to wipe out the depreciation recapture or take it down. So it's not necessarily net new cost. It's just that it's net neutral in the future. So another eye chart, what classifies bonus depreciation for 5-year, 15-year. You can see that on the right, the building, the walls, the floors, the really infrastructure is 39 years. You can't, this is a commercial property, but same thing for residential properties. And all the interior stuff, the lighting, security systems, the cabinetry, carpentry are 5 years. There's a bunch of other stuff that are 15 years, asphalt, monument signs, landscaping. So these are the kind of things that you should look for when you invest in something. Does it have a lot of interior stuff? Is it just bare bones? If it's just bare bones industrial, potentially there's less to bonus depreciate. Of course, I'm not CPA or engineer, but this is my take on it.
While we're on this topic, question of how do you calculate land value? Is it top-down comps approach or bottom-up cost seg?
Yeah, that's a very good question. So it really depends on the method of cost segregation you want to do. So the bottom-up cost seg, there are different, there are, I guess, companies that specialize in just doing cost segregation for you. So KPKG, I think, one of them, or Tyneco or CSSI. So they would, have an engineering team going on site and do a little calculation for you to be the report and audit support, right? The top-down approach is you look at comps, which is definitely, it's a possibility as well. And I know there are CPAs and advisors that can just use the software and look at the comps and calculate the cost seg for you. Now, the land is not going to be depreciated. Only the building portion is going to be depreciated. So just want to make it clear. But yeah, there are different approaches as how to come up with the value for the depreciation.
Mm-hmm.
Hope that makes sense.
So what can you depreciate when you can't? So as Mia said, you cannot depreciate land. You cannot depreciate your own house that you live in. Unless you're renting part of the house, then you can depreciate a part of that, right? Or an ADU, or a vehicle that weighs over 6,000 pounds, or a private jet, or partial private jet, or patents, IP software, stuff that you use for your business. But you can't depreciate these lands, collectibles, stocks, etc. Another thing that I want to highlight, and I'm going to go a little faster because we're running out of time, a 1031 exchange. I don't need to necessarily tell you what 1031 exchange is. Hopefully you guys know, but basically when you sell something, you have a time limit to identify 3 properties and then exchange into another thing. It has to be a higher loan value, I believe, right, Mia?
Yes, sorry.
Yeah. So higher loan value, so essentially you get to buy essentially something bigger typically. So 1031 exchange and depreciation is really great synergy because when you invest in something, you get cash flow, you get depreciation, and you get capital gains. That depreciation is also classified as capital gains in some cases, and in this case. And then when you 1031 exchange, you keep deferring it, right? It's all about deferral. You defer to the new property on your tax. So those capital gains adjust the cost basis down on the new property. You get more depreciation as well on the new purchase, which hopefully you can defer and defer again. And if you, I'm just gonna skip this part because we're running out of time. If you go and 1031 exchange again and again and again, and then you pass away, and you set up correctly, your estate passes to your heirs tax-free because it gets now adjusted to the cost basis. So all the taxes that you have deferred now gets eliminated. So that's a really cool thing. That's why people are, 1031 exchange and they buy properties, and if you buy it in enough frequency, you can keep compounding and stocking up on those losses. That helps you shelter all those gains, hopefully you're making on the cash flow. So I want to quickly highlight opportunity zones. Can go through this fast, apologize for that. Essentially, for those who don't know, Sean Parker was one of the instrumental lobbyists for this. And he turned to this. It's really a little known part of the tax code since the 2017 Jobs Act that allows folks to invest in these areas, which are state defined, and they will be, they're nominally supposed to be like a special operating zone where, local government wants an investment into the area, but they're also available in San Jose and parts of Houston. So they're not necessarily in the most impoverished areas. The 3 tax benefits of investing in operating zone is tax deferral. So if you sell stock or business or real estate, if you have capital gains, both short-term or long-term, if you invest in qualifying option fund, you can defer those taxes until December 31st. So we talked about the benefits of deferral, don't need to say that. And then reduce it by 10%. And this reduction goes away at the end of 2021 because you have to hold it for 5 years. And currently the law states that you have to pay those taxes at the end of 2026. And then if you hold it for 10 years, all future capital gains, not the original capital gains, all future capital gains, which includes depreciation recapture, because that's classified as capital gain, gets eliminated. So all the benefit you've received on the depreciation goes away from an expense in the future. So you don't have to do the 1031 exchange. Although, of course, if you do 1031 exchange, it acts like this, but it gives you a lot more flexibility. And in addition, the future capital gains on that property does not, you don't have to pay taxes on it if you hold for 10 years. And so
Eng, on that, can you classify which capital gain is short versus long term for when you're investing in the opportunity zone?
So maybe that's a question for Mia. In terms of, let's say some investor had made $150,000 of capital gains, and $100,000 was long term, $50,000 was short term, and they only invested $100,000 into an OZ. Could they pick and choose where they source that capital gains?
I believe they can. I think most of the opportunity zone funds would request a minimum. And then you can tell me if this is incorrect, but a minimum of $100,000 at least of investment. So you have and there are some funds that allow you to invest less than that. But if you can contribute, I don't think that'll be an issue.
Mm-hmm. Yeah, and so definitely most funds have a minimum of $100,000. We do have a qualified options fund right now. I believe some of you guys on the call, potential investors, our minimum is less than $100,000. We want to really, but it has to be capital gains, right? One thing I really advocate for is not paying taxes in the future, and investing and compounding your hard-earned money.
And sorry, just one other question on the topic. The opportunity zone 10-year capital gain elimination assumes you invested in 2016, question mark. Are we too late for this now?
Actually, I think I just got a little nervous. I think you have 180 days from the sales from the gain to invest.
Yeah. So you have 180 days from the sale of gain to invest. So you sold stock now, you have 180 days from now. But there was an extended window. If you invest within this year, you have a longer window. And of course, that as soon as January 1st hits, that window is now reverted back to 180 days. But essentially, the window allows you to have an extended window all the way back as far as October 5th, 2019, through this iOS notice 2020-39. Very sexy stuff. And I just want to highlight one more example, and then I think we'll just open to questions. When you invest in a qualified option zone, if you have long-term capital gains of 20%, and I'm not counting state, and I'm not counting short-term, and essentially getting a 20% discount on your investment. You think about it that way. So if you're able to compound that extra 20%, that's great. If you're now owe that 20%, that 20,000 at a 10% discount in 5.5, 6 years, that's amazing as well. And all future capital gains, including the long-term capital gains appreciation, which I'm highlighting the 32,000, and as well as the depreciation benefit of the $37,000 save of depreciation recapture of, in this case, I'm using real world example of one of our deals. You would save all those capital gains as well on future capital gains. Of course, cash flow does not count for the capital gains, but the depreciation recapture and the sell and the capital gains does count as being eliminated. I know this is a very popular topic, real estate professional. I just want to highlight that it does take quite a bit of work, but it's definitely possible if you plan it ahead with your CPA. Most times when we think about converting income from active to passive, that's what we try to do because of the potential tax benefits of passive. But if you're converting passive to active, you're doing it because you have so many passive losses that you can convert those passive losses into active losses and shelter your active income, which is what I've done. And, you know, I want to end with the fact that a lot of folks make a lot of wealth through real estate investing. And Andrew Carnegie said this when Millionaires was a very big thing, a very big deal. And it continues to be true. And Donald Trump, crony Donald Trump here from the first presidential debates. And I want to say that I enacted a lot of these strategies. That's how I've learned them. You know, you learn more by doing. And I've been able to take a lot of these strategies to defer and take bonus depreciation, cost segregation studies, all these really great benefits to have a $1.8 million of losses that shelter my active income. Now, of course, my real estate professional status helped me here, but this is how I'm taking advantage of it. And if you plan it well with a CPA, I think you could take some advantage of these strategies as well.
Great, thank you both. So just some questions still on the opportunity zone topic. So the opportunity zone expires in 2026. So wouldn't the 10-year hold have to have started in 2016?
No, the opportunity zone expires on the 10-year benefit expires on 2041. I'm not 100% sure of that, but I'm pretty sure it's a lot longer. The 2026 benefit is you owe your deferral at 2026. So if you invest in opportunity zone in 2021, you have 5 years, which then goes to 2026 to reduce it by 10%. If you invested in 2022, that 5-year window cannot happen because now you only have 4 years to pay. So you still defer your capital gains for 4 years, but you don't get a reduction. The 10-year window continues to hold true until 2041. I'm not exactly sure what will happen after 2026. You probably likely won't have tax deferral, but if the law remains as it is, you can still invest with capital gains. You won't get any deferral benefits. You still have to pay taxes, but you get the future capital gains benefits. And of course, these are local defined areas. To qualify for opportunity zone, you have to put 100% capital improvements into it. Typically, that's a development or a redevelopment. You can also buy at certificate of occupancy, meaning that you're using the original use clause and you're buying something that hasn't opened yet. And that's something that a lot of people do. Or you can invest in a qualified opportunity zone fund like what we have.
Great. And this other, I have a question from earlier that was related to the depreciation expenses and passive investors. So this is a scenario. If a passive investor in residential real estate has a 12K loss and has gains of 12K from a different commercial real estate investment, can that loss be offset?
Yes, this is a question for me. My first disclaimer is talk to your CPA just to make sure if there's not any complications with it, but I would think it is possible.
Yep. It sounds like both of those in that scenario were passive. So short answer would be yes, but yes, Mia's disclaimer of talk to your accountant.
Yeah.
What are some of the tax deductions available to W-2 people with a side business?
So if you have a side business and that side business is not making money for say 3 to 5 years, over 3 years, then there's a risk of the IRS reclassifying the expenses or the side business as a hobby, and so you risk getting audited, or they might not allow the expenses. So be cautious if you have a side business. Make sure that the business makes some money. But some of the tax deductions, I mean, no matter what kind of business you have, if if it's an active business, you make 1099 income, or make it an S corp or C corp, you make some money. And so the same tax planning strategies can still apply to you, meaning we can do legal entity restructuring, we can max out your deductions, we can max out your retirement contributions. So, so there are just a lot of strategies that we can help you with. You can also invest with Eng and have a loss. And if your side business is, say, if you are on the side as you are a realtor, you have passive income and you have an active realtor income and passive losses from investing with Eng, then you can take advantage of what Eng talked about earlier, paying no taxes on your income.
And I know we're out of time. We have 3 other questions that I think will be quick, but obviously we understand if people need to start dropping off. I think this is related to opportunity zones from a context perspective, but do you have to invest in the same tax year as you sell?
So when you're selling something, you have 180 days to tender exchange in something. So that could spread over 2 separate calendar years. But if you're not doing any of that, and you're buying something and you're getting a gain, and you're selling, or you're selling something, you're getting a gain, and then you're buying something and you do a cost seg study and you're getting a loss, which is something that you could do. You don't actually have to do all these other stuff that I've mentioned. You could still essentially sell an asset, for example, for $1 million, make $500,000 of gains, take those gains, invest and buy something for $2.5 million, and get cost seg study, depreciation, and benefit of $500,000 to wipe out the first $500,000 you owe. Essentially, as long as you keep investing in the same calendar year, in this case, it washes out as a P&L, right? You have a gain and you have a loss. And I think that's the overall theme of the tax code. The tax code is about making sure that the American people invest their capital. If you invest your capital, there are favorable tax treatments of your investments.
Great. And Mia, when's the best time of the year to start tax planning? Mid-year, beginning of the year, end of the year?
I would say anytime that you have a chance to talk to your accountant. I would say beginning of the year, it's definitely better than waiting until the end, because the longer you wait, the longer you're missing out on certain strategies. Like, for example, there's a tax strategy that allow you to write off expenses related to corporate board meetings. And so, if you know about this strategy at the end of the year, you can only write off 1 board meeting expenses. But then if you know about this at the beginning of the year, you can write off 12 meetings expenses. And so it's an example of how proactive planning can help you save more.
Great. And final question, will the new administration get rid of 1031 exchanges?
It's definitely been on the news. I think it will be a lower priority item. If you think about this from a self-preservation perspective, nearly 85% of congressional members are real estate investors. None of them are Apple employees or W-2 employees. So try to align your incentive with those in power. You'll never go wrong with people self-serving and helping themselves out. That's generally the facts of life. Of course, it could happen. Anything could happen. And so in general, taking advantage of it now is better than hoping that it still exists in the future. And by the way, we want to end with this, that Mia is graciously offering a free consultation service to everyone here. So feel free to reach out to her here. Mia, you want to talk about a little bit about that?
Yeah, I'm thinking, I think you're posting my website in my email here, and then I can send an email to everyone who attended the webinar today, which includes the link to my calendar, so you can just book a time to talk.
Yeah.
Thank you.
All right. Anything else, Brett?
No, I think that wraps us up. So look forward to reaching out to Mia and Eng if you have further questions or want to get in touch. Thanks everybody for your time. We'll send out this link shortly.
Thanks, guys. Appreciate it.